Hello, welcome to Module 5. In this module, we introduce basic accounting principles or conventions that everybody, and I mean everybody, has to follow. These are the universal laws of accounting, so it's important. These are known as generally accepted accounting principles and go by the popular acronym GAAP. In accounting, the rules are set by a private body called the Financial Accounting Standards Board, or FASB as it's known by its nickname. The key word is private body. It comprises 9 people from industry who serve a 5-year term. Can you tell me what the problem is of having a private body set important accounting laws? Remember, the chief decision makers, the big 9, are obtained from industry. They make the rules, and when they serve their stint, guess what? They go back into industry. Do you see a problem with that? Think about it. Yes, they could be making self-serving rules. So the FASB is overlooked by another body, the Securities and Exchange Commission. The SEC has the authority to veto any laws made by the FASB that's seen as self-serving. However, to be very honest, the SEC has very rarely exercised this veto power, but, as I said, it has the power to do so. The basic accounting concepts that underlie the preparation of all financial statements, as I said before, are called generally accepted accounting principles. There are 9 of them. And I'm going to go through each one of them. They are the time period assumption, revenue recognition principle, expense recognition or matching principle, monetary unit principle, economic entity principle, going concern principle, full disclosure principle, cost principle, and materiality. Let's start with the first one. This actually started around the year 1492 in Italy. At that time, merchants formed joint stock companies and got money from investors. They used the money to purchase ships and raw materials. These ships then sailed halfway around the globe and traded with countries like India, China, and countries in Africa. How long do you think it took the ship to get home? Remember, it's 1492. We can't say. The joint stock companies used to tell investors to wait till the ships returned home before they could figure out the profits and then distribute them. Let me repeat that. The joint stock companies in the 15th century used to tell investors to wait a couple of years before they reported their profits. Can companies do that in today's environment? Can a company building skyscrapers, for example, tell investors to wait 2 years till the project is completed for them to report their profits? What do you think? No, absolutely no. Companies have to report every year. This is the time period concept. The life of a company is broken down into artificial time periods. Financial reports have to be prepared annually and shown to investors. The most popular date for doing that is December 31 of every year, but companies can choose their ending year. But the rule is, every year they have to report their profits. They can't complain, well, we never finished a project. Now, let's move on to revenue recognition. I want you to look at this diagram for a minute. Company X sells, let's do a makeup product, call it widgets. As shown in the slide, they receive an order for 30,000 worth of widgets on January 1st. They deliver the widgets to the customer on February 1st. They get cash on March 1st. Let me ask you a question. When do they recognize revenue? Is it January 1st when they got the order? Is it February 1st when they delivered the items? Or is it March 1st when they received the cash? What do you think? Think about this for a couple of minutes. Did you get it? Well, if you said March 1st, you got it wrong. The law or recognized accounting convention for corporations is that you recognize revenue when it's earned. That is, when they do something, either deliver a product or provide a service, when it's earned. Look at the diagram again. When did they do something? February 1st. So on February 1st, they got to show revenue. Here's another diagram. This shows the entire production and sales cycle. Let me repeat this, it's important. During production, you can't recognize revenue because you didn't sell anything. At the end of the production cycle, a company can't recognize revenue. If you look at the last point on this chart, that's when cash is received, they cannot recognize revenue. They have to recognize revenue at the point of sale. That's at the point of delivery. This is very important. Accounting is all about double entry, so let's look at the double entry of this. Here we go again. It's exactly what I told you. You receive order on Jan 1st. You deliver on February 1st. You got the cash on March 1st. Let's start from the top. What's the double entry when the company receives the order? The answer is nothing, because nothing has happened. At this point, there's no transaction. What's the double entry when we go to the next step, when delivery is made to the customer? When a company delivers, I just told you they got revenue, so revenue goes up 30,000. The customer owes you money, so accounts receivable goes up 30. So the double impact is revenue plus 30,000, accounts receivable plus 30,000. When the company gets the cash, cash increases by 30,000 plus 30. And now the customer doesn't owe you anything. So accounts receivable decreases 30,000. So at this point, the double impact is cash plus 30,000, accounts receivable minus 30,000. Let's make it a little bit complicated. Look at that diagram. Has it changed? What's the difference between this and the other diagram? I'm going to stop for like 30 seconds, and if you can't see the difference, I want you to go back and check the diagram and think about the difference. Have you got it? In this diagram, you received the order, then the company got the cash, and then they delivered the product to the customer. So they got the cash before providing the service. What happens if you got the cash first and did your delivery later? Now, what's the double entry? When you receive the order, as before, nothing happened because there's no transaction. When you get the cash, the double entry is cash increases 30,000 and a liability increases 30,000. Why a liability? You created a liability because the company right now owes the customer the money, since the company has done nothing for the customer. So they owe the customer. You got to call this liability a name, and it's called unearned revenue. So the double whammy is cash plus 30,000, unearned revenue plus 30,000. It's unearned because the company got the cash, but they haven't done anything. And please remember this, I'm giving you a hint for your first exam. Unearned revenue is a liability. Now let's go down. When the company delivers, they have revenue. So when they deliver, the double whammy is revenue increases and the liability decreases. So revenue is plus 30,000 and the liability, unearned revenue, minus 30,000. It's minus because since the company delivered, right now, they don't owe anything to the customer. The concept of unearned revenue is important, so let me repeat. Unearned revenue, when you see it on a balance sheet, it's a liability. Was that difficult to digest? Let's keep going. Now we go to the concept of expense recognition. Have a look at the diagram in front of you. To explain expense recognition, look at the following. Let's say your company X, you receive a utility bill for 1,000 on January 1. You make payment of cash on February 1. When do you recognize an expense? Expense recognition states that you recognize an expense when the company receives a product or service. So it's January 1. Remember, it's not when you pay cash. Let me repeat. Not when the company gets cash. Expense is recognized when the company receives a service and the bill. So, what's the double entry impact? On January 1st, we just said an expense is created because you received the bill. So, utility expense goes up, and what's on the other side? Accounts payable, because you owe money to a supplier. So, accounts payable will increase. So, here's the double entry. Expense plus 1,000, accounts payable plus 1,000. What happens when you pay cash? Cash goes down, minus 1,000, but your accounts payable will also be minus 1,000 because since you paid, you don't owe any money to your supplier. Believe it or not, this is the easy part. Let's make it a little more complicated. Look at the next diagram. Do you know the difference between this diagram and the previous diagram? Just go back for 30 seconds and look at the previous diagram. Can you see the difference? In this case, the company paid the cash first, so it's prepaid. They received the product or service at a later date. Now, let's say the company prepaid before they received the bill and service. What's a double entry on January 1? Based on the knowledge you got from your previous 4 modules, can you spend a minute and think about it? Stop this recording if you have to. I'll give you a minute. Are you done? At this point, January 1, there's no expense. This is because no service was received yet. But you paid the money, so cash goes down. An account called prepaid expense is created, so prepaid expense goes up. There you go. Cash goes down and prepaid expense goes up. This is important. Prepaid expense is not an expense. It's an asset. Prepaid expenses are shown on the balance sheet as assets. How come? Think about it. Because you paid the cash to your supplier, the supplier hasn't provided you with the service, so at this point, the supplier owes you. So the supplier at this point is an asset. So just remember for your exam, I'm giving you a hint, prepaid expense is treated as an asset. What's a double entry on February 1st? On February 1st, you received the service and the bill. So now an expense is created. So expense is plus 1,000. Right now, they don't owe you anymore, so prepaid expense is minus 1,000. So the net result is that, overall, cash goes down and an expense is created. The prepaid expense is a temporary account that's treated as an asset until the bill is received, then it gets converted to an expense. I need to repeat that since it's important. The prepaid expense is a temporary account that's treated as an asset until the company receives the service and the bill, and then it gets converted to an expense. The 2 most popular prepayments are for insurance and for rent. Think about it. Don't you pay your rent in advance? Don't you pay insurance in advance before you get any service? So if you look at the balance sheet of a company, under assets, you'd see prepaid rent and prepaid insurance. The practice of expense recognition is also referred to as the matching principle. This is because it dictates that efforts, expenses, be matched with accomplishments, revenues. So what we just talked about is called the matching principle. Now, let's go to the next key accounting convention. It's called the monetary unit assumption. The monetary unit assumption states that only transaction data that can be expressed in terms of money can be included in the accounting records. Remember that. Only transaction that can be expressed in terms of money, dollars, can be included in the accounting records. For example, the company president is important. The value of a company president is not reported in a company's financial records because it can't be expressed in dollars. Look at the diagram below and tell me which of these will be reported in a company's financial statements. I'd like you to stop this presentation, have a crack at it. When you're done, restart. Are you done? Let's say you have a lot of happy employees. Can that be expressed in money? No. That's ignored. Salaries paid. Can that be expressed in money? Yes. That's included in financial statements. Customer satisfaction. No, you can't measure it. Hiring of a new president? No, can't measure it. Think about this one. Destruction to buildings by fire. Would you show that as an expense or loss in an income statement? The key question is, can you measure it in dollars? Answers, yeah. So you would see that in an income statement under expense or loss. Purchase of new equipment. Can that be measured in dollars? Sure. So that will go into your financial statements. That wasn't too bad, was it? Okay, let's go to the next one, the economic entity assumption. The economic entity concept or assumption states that the business is a distinct and separate entity from the owner. The owner and the business are two distinct, separate entities. I just realized the owner on this picture looks like George Bush, but that was an accident. So, if the owner and the business are distinct and separate entities, what is the implication? As I said, let me repeat. The economic entity assumption states that the business is a distinct, separate entity from the owner. The implication is creditors can sue a business for non-payment, but they can't sue the owners because the owners are considered as a separate entity. This is also called limited liability. Let me tell you a story. The CEO of a company called Alcatel was taken into custody for violating the economic entity assumption. So that's how serious this is. The executive used company funds to install an expensive security system in his home. What did he do though? He got it charged under miscellaneous expenses in his company accounts. He can't do that. His home is separate from the business. So he violated the economic entity concept. If you violate any of the concepts we're talking about, it's a prison term. So it's important. So let's go on to the next one, the going concern. The going concern assumption states that the business will continue in operation long enough to carry out its existing objectives. That means into the foreseeable future. So if a business is described as a going concern, that's good. It means it's expected to continue into the foreseeable future. I try to illustrate this by this diagram in front of you. You see a factory in Newark, and the next picture is the factory of the future. So I'm trying to make the point that going concern is a simple concept. It means that the company will continue in existence. If a business is considered to be a going concern, it has to follow certain procedures. One more time. The going concern assumption states that the business will continue in operation long enough to carry out its existing objectives, that is, into the foreseeable future. If it's considered a going concern, it's vital that it follow certain laws. Look at the diagram in front of you. If a company is not a going concern, or it's described as non-going concern, it means that it will go bankrupt within a year. Look at the diagram carefully. If a company is considered going concern, the assets in the balance sheet are shown at cost. That's what the company paid for it. For example, if a company paid $100,000 for inventory, that is what it's recorded at, $100,000. Similarly, if a company bought buildings for $5 million, that is what it's recorded at, $5 million. If a company is not a going concern, the assets are valued at something called liquidation or distress price. What do you think? Is that high or low? Distress price is what you could get for it if you sold it in the market right now on the basis that you had to close down your business. Would buyers offer a high price or a low price? No brainer, right? Definitely low. So if it's not a going concern, you have to value your assets at liquidation price. Similarly, when you do the balance sheet, if a company is considered a going concern, on the balance sheet, they have to break down assets into current and long term. If a company is not a going concern, and it's assumed that the business will go bankrupt within a year, all the assets are shown as current. They don't break it down. Is that clear? Let's go to the next one, the full disclosure principle. The full disclosure principle requires that circumstances and events that make a difference to potential investors must be disclosed. The company must disclose everything that would interest you as a potential investor. Let me tell you a story. Years back, a company called Manville Corporation. Does that ring a bell? Manville Corporation was sued by 52,000 former employees and their dependents because they contracted cancer while being exposed to asbestos working at Manville. The total claims exceeded $2 billion. Would it influence your decision to invest if you knew that the company you were interested in was being sued in excess of $2 billion? If the answer is yeah, then you would agree that Manuel would have to disclose it. How about this? You do know the story of Dow Corning, and the things they made for ladies, unfortunately, the product they made didn't work well. There was leakage, and they were sued for $4 billion. Question: should Dow Corning have to disclose $4 billion of lawsuits against it by dissatisfied customers of its products? Definitely. If someone sued a company for $500, would that change your decision to invest in the company? Chances are no. So the company doesn't need to disclose that. So let me recap. What is full disclosure? The company has to disclose everything that could interest a potential investor. If you look at a company's financial statements, where would you find it? There are two areas. The first note in a company's end notes is called Summary of Significant Accounting Policies. That and the subsequent notes to the financial statements disclose, or are supposed to disclose, everything that would interest an investor. Remember, if they don't disclose something, which they should, you as an investor can sue them. Here's the problem though. Accountants could disclose every financial event that occurs and every contingency that exists, but in most cases the cost of doing that would far exceed the benefit. So determining where to draw the line on disclosure is not easy. Let's go to the next one, the cost principle. Cost principle dictates that assets be recorded at their cost, which is what you paid for it. Assets are recorded at what you paid for it. Cost is used because it's both relevant and reliable. Do you think that's a good way of measuring assets? I need to tell you that the cost principle has come under criticism. Some criticize it as irrelevant. After acquisition, so the argument goes, the cost of an asset is not equivalent to market value or current value. For example, if you buy it for $80,000, you have to show it on your balance sheet at $80,000. But if somebody tells you, well, hey, the market price is now $200,000, the law says you got to show it at 80, right? So you're undervaluing your asset. So you could make a case, well, the numbers on the financial statements or the balance sheet aren't accurate. So the cost principle isn't really perfect. Let me tell you a small story. An individual went to sleep and woke up 10 years later. Hurrying to a telephone, he asked what his formerly modest stock portfolio was worth. He was told that he was a multi-millionaire. His General Motors stock was worth $5 million. He was so elated. He was about to inquire about his other holdings when the telephone operator cut in with, "Hey, your time is up. Please deposit $100,000 for the next 3 minutes." This is a story to make the point that the use of the cost principle doesn't help really show the value of assets. It doesn't really help show the real value of assets. But that's the law, and accountants have to do it that way. Let's go on to the next one, materiality. Materiality relates to an item's impact on a firm's overall financial condition and operations. An item is material when it's likely to influence the decision of a reasonably prudent investor or creditor. It's immaterial if its inclusion or omission has no impact on a decision maker. Generally, if an item is material, you have to show it as an asset. If an item is immaterial, you can just throw it in as under miscellaneous expense. Look at this for a minute. Here's an accountant, and he's got a couple of things to deal with: waste paper baskets, motor vehicle, furniture, tools. Which of these are material? Do you want to spend a few minutes thinking about it? Let's take the first one. A waste paper basket is a low-cost asset. Is that material? No. So waste paper baskets aren't shown as assets, they're expensed immediately. Are motor vehicles considered material? Yes. So they're considered as assets and shown on a company's records. Furniture? Yes. Material. So they're shown as assets on a company's records. How about tools? The chances are you don't want to waste time and effort recording them, computing depreciation and so on. Tools aren't material, so when you buy tools, it's expensed immediately. Now, let's go on to the final concept, conservatism. What's it all about? The conservatism constraint dictates that when in doubt, choose the method that will be least likely to overstate assets and income. Did you get that? Okay, let me illustrate. Let's take a company that overstates its profits and overstates asset values. Everything's overstated. And let's say they don't do as well as they would have liked. Could an investor sue saying that the company had misrepresented if things don't work out well? Sure they could. What about the other way around? If they understated profits and they understated asset values, and investors looking at the understated numbers still invested in the company, would they sue saying, "Hey, you did better than we expected"? Chances are very remote. This is why conservatism is important. Always go with the lower profit, lower value, because chances of lawsuits are mitigated. A common application of conservatism is in the valuing of inventories. Look at the example below. I want you to spend a minute reading this example. Here's a little exercise. Inventory cost 80,000. The market price is 120,000. Which value should be shown on the balance sheet? Next example. Inventory cost 80,000. Inventory cost 120,000. The market price is 80,000. Which value should be shown on the balance sheet? The answer is you go with the lowest in every case. What does conservatism say? Go with the lower number. So go with 80,000. Okay. Now let me test your understanding of these concepts. Here's a little exercise for you. What I want you to do is print this out. Then I want you to try it, and after you're done, get back to this presentation. What I want you to do, on top you have all the concepts we talked about. On the bottom, you have different statements. I want you to tell me which is being followed in each case. Example, let me do part A for you. Important information related to inventories is presented in the financial statements or in the footnotes. Which of the concepts does it apply? Answers full disclosure, which is number 5. Try the rest. Stop this presentation and try to match the statement with the assumptions and laws. When you're done, I'll give you the answer. Are you done? Well, here's the answers. The first one we discussed, it's a full disclosure. Assets are not stated at their liquidation value. They're applying the going concern, which is number 2. The death of the president is not recorded in the accounts. What are they following? The monetary unit assumption, which is number 3. Pencil sharpeners are expensed when purchased. What are they following? 9. Materiality concept. An allowance for doubtful accounts is established. What are they following? Number 7. Matching principle. An entity is kept as a unit that's distinct from its owners. What are they following? Number 1. Economic entity assumption. Reporting must be done at defined intervals. What are they following? Number 4, time period assumption. Revenue is recorded at the point of sale. What are they following? Number 6, revenue recognition. When in doubt, it's better to understate than overstate net income. What are they following? 10, materiality. If you're comfortable with this, try one more. Here it comes. I want you to print this out too and tell me in each case which concept is being violated. Let me try the first one for you. Person company is in its 5th year of operation and has yet to issue financial statements. What are they violating? Number 4, time period assumption, which states that you got to make a report every year. So print this out, do it. When you are done, go to the next slide, which has the solution. Stop this presentation and try this exercise. Are you done? Here's the answers. Did you get it? Everything perfect? If so, you have really understood this module. Thank you. We're done.